Hello everyone and welcome to Fun with Fitzy. We are now on chapter 11, video number 1. We are focusing on merchandise companies, okay? So merchandise businesses. Right from the beginning of the course, I remember the first week we were talking about service companies versus merchandise companies. We all know that service companies are businesses that sell a service rather than a product or a good. And we also know that merchandise companies buys goods and sells them at a profit. Okay, and remember when you see this guy, this is probably something that you should write down. There are wholesalers. These are the guys that buy goods from manufacturers, the guys who make them, and sell them to retailers, the guys who sell them. Retailers buy good from the wholesalers and manufacturers and sells to the public. Businesses that buy goods for the purpose of selling them at a profit are dealing in merchandise, and we call this our inventory. Don't get confused with supplies. Okay? So the quantity of merchandise on hand is known as merchandise inventory. This is an asset account. It is a current asset. Let's look at this. So at the beginning of the fiscal period, you have some inventory, we're going to say. And we're going to call this cost of goods available for sale. And you'll see me say cost of goods available for sale during the fiscal period. So what is made up of this? Well, you're either going to sell it or still have it. So goods not sold are on hand still at the end of the fiscal period. However, the goods that were sold during the fiscal period are now sold. Okay, and this includes stuff that gets lost, stolen, or broken. Okay, we're going to talk about this too. Goods that are still on hand will show up on your balance sheet as a current asset. We just talked about that as a merchandise inventory account name. Goods that were sold will show up on your income statement as a cost of goods sold. This is an expense, but it's not going to go in your operating expense section. Just remember, the cost of goods sold is an expense and merchandise inventory is an asset. Why is this an expense? Well, if you buy something, let's say this pen I'm using, you can see it here, say I bought it for $5 and then I sold for $10, well, that $5 was my expense and that's going to be the cost of my goods sold. I sold it for $10, but it cost me $5. So the cost of goods sold in this case was $5. There are two different systems that we could look at. Periodic, and the other one is called perpetual. The periodic inventory system, I'll write this down again, here's our dude, determines the cost of the inventory sold at the end of each fiscal period. Whereas in the perpetual, it's all the time, ongoing, let's say. You always know what your cost of goods sold. We're going to be looking at the periodic inventory system. No up-to-date inventory records are maintained throughout the accounting period. Okay, we calculate it at the end. It is the most common and least expensive inventory system. However, let me tell you now with computers, perpetual system is much easier now that we have computers. So let's look at the inventory cycle. Hint, hint, there's one question on the exam like this. The inventory cycle goes like this. Merchandise moves in and out of the business in a regular pattern. There is inventory at the beginning of the accounting period because there's still some inventory in your warehouse. Then you sell some on a continual basis, so it's always moving out during the accounting period. Merchandise is periodically replaced by the purchase of new stock. So you have some, you sell some, you always purchase some, and the inventory at the end of the accounting period is more or less the same at the beginning. Okay, so this is the regular cycle. You can kind of view this as a circle and it keeps going round and round. There's going to be a formula that I want you to know. This kind of makes sense. So the cost of your beginning inventory, let's say I had these pens, and let's say they were $1 each, and I had 10 of them. So the cost of the inventory that I had on hand was $10. The cost of the merchandise purchased, say I bought 5 more, so I had $10 up here, disappeared. I bought 5 more pencils and they were $5 each. Let's add 5. minus the merchandise sold. So let's say I sold 3. Will tell us how much we had on hand. So the cost of our ending inventory, so we had 10 each, so it was $10. We bought 5 more, so we had $15. We sold 3, therefore we have $12 is the cost of our ending inventory. So our ending inventory, that merchandise inventory account with our asset, is going to be $12. Okay, so let's look at the financial statements. The ending inventory is reported as a current asset on the balance sheet. We talked about that already. However, it is used to calculate the cost of goods sold. And the ending inventory, again, is used as the beginning inventory. So let's say December 31st, you had $700 worth of inventory. Well, guess what? January 1st, you still have $700 worth of inventory. So here's your ending inventory, becomes your beginning inventory. That makes sense, right? Well, let's look at the balance sheet, okay? So our ending inventory is reported in the current asset section, and it's going to now be our merchandise inventory. So what information do we know about the merchandise that flows through a company? The value of the inventory at the beginning of the fiscal period, we know. We know the value of the goods purchased, and we know what we had on end. How do we know this? From counting. This is the physical inventory. Okay, so let's look at a formula. Okay, do not forget this formula. Beginning inventory plus purchases minus ending inventory. Beginning inventory plus purchases minus ending inventory equals cost of goods sold. Remember, remember, remember. Let's see what it looks like on our income statement. Okay, so look at this. Ending inventory is on our income statement as well as our balance sheet. It is one of the only accounts that shows up on 2 different financial statements. We need it to calculate our cost of goods sold, like I just said, which is needed to calculate our gross profit, which we're going to spend a lot of time doing in this chapter. So let's look at our inventory, our income statement. This is going to be new for us. Remember, in the past, our income statement was revenue minus expenses. Well, on a merchandising company's income statement, you're going to have revenue minus cost of goods sold equals our gross profit right here. So remember, on our financial statements, when you're doing some math and you need to subtotal, you move it into the left. So here, this company had $231,967 in sales. So again, we had beginning inventory plus purchases equals cost of goods available for sale. That's just a little subtotal. But really, if you look at the whole formula here, beginning inventory plus purchases minus ending inventory equals our cost of goods sold. That's the formula that we just talked about. It goes right on your income statement. So if you can remember that formula with the little subtotal in the middle of it, just so we can see what our cost of goods available for sale throughout the period was, then you know your cost of goods sold number. Once you know your cost of goods sold number, you can take your revenue minus the cost of goods sold, and this company had a gross profit, which is good. And then you subtract all of your operating expenses, which you're used to seeing already, to get your net income at the bottom. So by now you should know the difference between service and merchandise companies, which you do from the beginning, be able to explain what the periodic inventory system is, be able to explain what a physical inventory is, that's when you count your goods, and know the cost of goods sold formula. Thanks for watching, hope this helped, and we'll talk to you later.